Hi there, it's Friday the 21st of June 2019. I'm Steve Towers. Welcome to ITB. Let's get started. The US Treasury and IRS have released a set of significant international tax regulations on two main topics, the GILTI regime and the dividends received deduction in regard to foreign dividends. 4 documents were released, 2 on each topic, or put another way, a total of 505 pages. If you'd like to obtain a copy of those 4 documents, which I call the 2019 regulations, please go to our website or app. The 2019 regulations for GILTI aim to finalise the proposed regulations which were issued in September 2018. The 2019 regs make 2 major taxpayer-friendly changes to the 2018 proposed regs. The first major change is the introduction of a general high tax exception. This will operate by way of an election to be made by a CFC's controlling US shareholder. The election would apply to all commonly controlled CFCs which meet the effective tax rate test. The effective tax rate test is that a CFC's gross income is subject to an effective rate of foreign income tax which is greater than 18.9%, which is 90% of the current US corporate income tax rate, 21%. And the second major change concerns the treatment of domestic partnerships. The 2019 regulations use a so-called aggregate approach in order to determine a partner's GILTI inclusion with respect to a CFC owned by a domestic partnership. This means that a domestic partnership cannot have a GILTI inclusion amount, and therefore the partners will not have a distributive share of any GILTI inclusion. Instead, partners in a domestic partnership will be treated as owning proportionately the shares in a CFC which is owned by the partnership. Therefore, a partner which is unrelated to the other partners and which, based on its proportionate ownership of shares in the CFC, does not qualify as a US shareholder in regard to the CFC will generally not have a GILTI inclusion. The 2019 regulations on the dividends received deduction for foreign dividends introduce a controversial anti-abuse rule. The anti-abuse rule relates to a possible timing mismatch between the final earnings and profits measurement date for the transition tax in Section 965, the start of the DRD rules in Section 245A, and the start of the GILTI regime in Section 951A. To address the timing mismatch, the anti-abuse rule will deny the DRD deduction. The 2019 regulations call the timing mismatch period the disqualified period. For example, a fiscal year CFC with a taxable year ending November 30 would have a disqualified period from January 1, 2018, the day after its final E&P measurement date under Section 965, to November 30, 2018, the last date before the GILTI regime in Section 951A applies with respect to its income. The Treasury Department and the IRS are aware that during the disqualified period, CFCs may have engaged in certain transactions with related parties with a goal to creating stepped-up basis for the buyer while generating earnings and profits for the seller CFC that are not subject to any current tax and may be eligible for the Section 245A DRD deduction. Because the transactions generally are structured to avoid creating Subpart F income and occur during the disqualified period, the income from these transactions is not subject to US tax under the transition tax under Section 965, the Subpart F regime or the guilty regime. The Treasury Department and the IRS have determined that it would be inconsistent with the closely interdependent set of international tax rules implemented by the US tax reform legislation, specifically the transition tax, the guilty regime, and the participation exemption, for the earnings and profits resulting from these transactions to be eligible for a Section 245A DRD deduction, even if the other requirements of Section 245A are otherwise satisfied. In fact, the anti-abuse rule is structured in two forms. Firstly, in regard to CFC to US dividends, there's the amendment to the Section 245A DRD deduction. And secondly, in regard to CFC dividends, there's a corresponding amendment to the Section 954 look-through exception for Subpart F income. So far, commentators have criticised the anti-abuse rule on the basis that Treasury and the IRS were not given the statutory authority to include such a rule. Some have suggested that the rule will be subject to judicial challenge in due course. Well, despite the current resolution of the threatened US tariffs on imports from Mexico, the global trade situation is still not good. The China-US trade war continues, with Huawei being a major casualty. But the two leaders will meet at next week's G20 Leaders Summit in Osaka. The latest adverse development is that India has increased its customs duty rates on a range of imports from the US in retaliation for the US terminating India's status as a beneficiary developing country under the Generalized System of Preferences program. The OECD has released new transfer pricing profiles for Chile, Finland and Italy, which brings the total number of jurisdictions covered to 55. For a copy of the new profiles, please go to our website or app. And the UN has released the report of the most recent meeting in April of its Committee of Tax Experts. The only item in the report which I found particularly interesting is the discussion of capital gains on indirect transfers. For a copy of the report, please go to our website or app. In Bangladesh, the government has presented its 2019 budget, and the only items to catch my eye are two changes to encourage companies to distribute more cash dividends to their shareholders. An additional 15% tax will be levied on retained earnings and reserves exceeding 50% of the paid-up capital of a company. And a 15% tax will be imposed on stock dividends distributed by listed companies. In Cambodia, the tax authorities have issued guidance on the 0% VAT rate for export services. According to the guidance, the 0% rate will apply in two situations. The first is where the services are performed outside Cambodia for a non-resident entity. And the second is where the services are performed within Cambodia for a non-resident entity, provided the non-resident entity does not use the services for any business purpose or economic benefit within Cambodia. The guidance includes a number of examples, including the scenario where a Cambodian company provides to a non-resident consulting services which are performed in Cambodia and which relate to the Cambodian investment environment. Those services would be subject to standard rate VAT. In China, the tax authorities have issued their 2018 report on APAs. The report shows that only 9 APAs were signed in 2018, of which 7 were bilateral and 2 unilateral. Also, 2 of the 9 were renewals. Since the commencement of the APA program in 2005, China has signed 156 APAs. Of those 156, 67 are bilateral, mostly with other Asian countries, and 89 are unilateral. Most of the APAs concern tangible assets, and the most common method is TNMM, with the profit level indicators most commonly being full cost markup and EBIT as a percentage of sales. As in previous years, the 2018 report provides useful procedural information on China's APA program. For your copy of the report, please go to our website or app. In India, the Mumbai Income Tax Appellate Tribunal has decided a case in regard to customer referral fees paid by an Indian company to a US company. The tribunal held that the customer referral fees were not subject to Indian tax for 2 reasons. Firstly, the fees did not fall within the domestic law definition of fees for technical services. The customer referral services were not managerial, technical, or consultancy services. And secondly, in any event, the make available condition in Article 12 of the India-US Treaty was not satisfied. For a copy of this case, please go to our website or app. And in New Zealand, the government has announced that the imposition of GST on low-value imported goods will be deferred from the 1st of October to the 1st of December 2019. For a copy of the government's announcement, please go to our website or app. Let's start with the European Court of Justice. One of the Advocates General, Julianne Kokot, has issued her opinion in the Vodafone case, which concerns Hungary's turnover-based telecommunications tax. Now, I don't usually cover Advocate General opinions. They don't form part of the court's judgment, and sometimes the court reaches a different conclusion. However, some commentators have suggested that Julianne Kokot's opinion in the Vodafone case might also be relevant to other turnover-based taxes, such as the digital services taxes which are being introduced in some EU member states. So for that reason, let me quickly summarise her conclusions. The opinion addresses 3 questions. Firstly, does the EU freedom of establishment preclude the tax because the actual tax burden falls on foreign-owned taxable persons? Secondly, does the prohibition on state aid preclude a member state from imposing tax on a progressive rate basis on turnover when the effect is that the actual tax burden for the highest tax band is borne mainly by foreign-owned taxable persons? And thirdly, does the Hungarian tax breach Article 401 of the VAT Directive, which generally prohibits member states from imposing new taxes if they are characterised as turnover taxes? AG Kokot gave a negative answer to all of these questions. For a copy of the AG's opinion, please go to our website or app. The European Court of Justice has decided 2 cases in regard to the issue of whether a Swedish company can deduct foreign tax losses incurred by a group company which is established in another EU member state. The basis for such a deduction would be the EU freedom of establishment. The 2 cases are called Mamira and Holman. Let's start with Mamira. Here are the relevant facts. The taxpayer, Mamira Holding AB, is a Swedish resident company. Mamira has a 100% subsidiary which is resident in Germany. The German subsidiary has ceased its business activities. It also has unrelieved tax losses. Mamira is considering entering into a cross-border merger with the German subsidiary, which would cause the subsidiary to be dissolved without liquidation. The issue in the case is whether the EU freedom of establishment would allow Mamira to deduct the German subsidiary's tax losses if the merger were to occur. As you would expect, the court focused on its landmark judgment in the Marks and Spencer case in 2005. In paragraph 55 of that judgment, the court held that a parent company can take into account the losses of a non-resident subsidiary where the non-resident subsidiary has exhausted the possibilities available in its state of residence of having the losses taken into account for the accounting period concerned by the claim for relief and also for previous accounting periods, if necessary, by transferring those losses to a third party or by offsetting the losses against the profits made by the subsidiary in previous periods. And there is no possibility for the foreign subsidiary's losses to be taken into account in its state of residence for future periods, either by the subsidiary itself or by a third party, in particular where the subsidiary has been sold to that third party. The court held that Mamira has not satisfied that Marks and Spencer test because it has not established that it can't sell the shares to a third party for a price which reflects the tax benefit of the losses. The court said this: it cannot be excluded from the outset that a third party may take into account for tax purposes the losses of the subsidiary in that subsidiary's state of establishment. For example, following a sale of that subsidiary for a price including the tax advantage represented by the deductibility of losses for the future. Consequently, in a situation such as that envisaged by Mamira, it is for Mamira to demonstrate that the possibility referred to in the previous paragraph is precluded. And now to the Holman case. Here are the relevant facts. The taxpayer, Holman AB, is a Swedish resident company. Holman has a 100% subsidiary, Intermediate Holdco, which is resident in Spain. Intermediate Holdco has a number of 100% subsidiaries in Spain, one of which, Losco, has unrelieved tax losses. The Spanish companies together form a tax consolidation group for Spanish income tax purposes. However, the losses of a company cannot be used in the tax consolidation group in the year the company is liquidated. Holman is considering liquidating Losco. Under Sweden's tax law, the tax losses of a non-resident sub-subsidiary are not transferred to the Swedish parent company upon liquidation of the sub-subsidiary. The issue in the case is whether the EU freedom of establishment would allow Holman to deduct LOSCO's losses if it were to be liquidated. There were two key questions which were considered by the court. The first was whether LOSCO's status as a sub-subsidiary of Holman, rather than a direct subsidiary, has an adverse impact on accessing the losses. The court held that it does not, provided all of the intermediary companies are resident in the same member state as the company which will be liquidated. The court expressly said that if an intermediary company is not resident in the same member state, then the losses cannot be accessed. In the Holman case, the one intermediary company is also resident in Spain. Accordingly, its presence in the structure did not prevent the losses being taken into account. And the second key question is the same issue which arose in the Mamira case. Has Holman established the no possibility situation as described in paragraph 55 of the Marks and Spencer judgment? Not surprisingly, the court gave the same response as in the Mamira case. For a copy of these two cases, Mamira and Holman, please go to our website or app. Well, according to the German finance minister, the financial transaction tax is close to agreement between the 10 member states which are likely to participate through the so-called enhanced cooperation, the Plan B option after unanimity amongst all 28 member states fails. Key to this situation is the mutualisation plan, under which tax revenue will be shared with the smaller participating states. Under the current design, the FTT would apply to the acquisition of shares issued by listed EU companies with a market capitalisation exceeding €1 billion. The tax rate would be 0.2%. Exemptions would apply for IPOs, market making, and intraday trading. And then there were 11. It was decided during the ECOFIN meeting last week that Dominica will be removed from the EU's blacklist of non-cooperative jurisdictions for tax purposes. For a copy of the press release on this matter, please go to our website or app. The European Commission in this last week has supported Portugal's request to apply a VAT reverse charge mechanism and has objected to Lithuania's request to do so. For a copy of the two documents issued by the Commission, please go to our website or app. And if you're a history student, you'll love this EU report. It's an overview of the 638 preferential tax regimes which have been examined by the EU Code of Conduct Group since its formation in 1998. For a copy of the report, please go to our website or app. In Guernsey, the tax authorities have published a circular which explains proposed changes to Guernsey's economic substance regulations. There are two main changes. Firstly, the application of the economic substance rules to Guernsey companies with exempt status, other than regulated collective investment schemes. And secondly, changes to the way core income generating activities are set out for different types of IP. For a copy of the circular, please go to our website or app. In the Netherlands, the government has launched a public consultation in regard to a new corporate income tax group rule. This is in response to weaknesses in the existing regime which were exposed in the XBV case in 2018. The government has drafted an options document which sets out 4 possible solutions. The consultation will remain open until the 29th of July. For the link to the consultation website, please go to our website or app. Also in the Netherlands, the government has responded to parliamentary questions concerning the impact in the Netherlands of the so-called Danish cases, which were decided by the European Court of Justice earlier this year. Those cases concern the EU Parent Subsidiary Directive and the Interest and Royalties Directive. For a copy of the government's response, please go to our website or app. And finally, in the Netherlands, the Prime Minister has issued a warning to large companies that they need to increase the wages of employees covered by collective labour agreements, or else the scheduled reductions in the corporate income tax rates might be reviewed. And in the UK, the government has introduced a VAT reverse charge mechanism in regard to suppliers of renewable energy certificates. The government is concerned about VAT fraud in regard to such certificates. For a copy of the government's policy paper on this matter, please go to our website or app. In Angola, the government has announced that the introduction of VAT to replace the existing consumption tax will be deferred from the 1st of July 2019, the scheduled introduction date. According to the President, the VAT will be introduced as soon as conditions are in place, preferably this year. In East Africa, 4 countries have synchronized the presentation of their 2019 budgets: Kenya, Rwanda, Tanzania, and Uganda. I've found nothing of interest from a tax viewpoint in Rwanda's budget. Let me take you through the other 3. Let's start with Kenya. There are a number of items to note. Firstly, in regard to corporate income tax, a reduced rate of 15% will apply for 5 years for companies which operate a plastic recycling plant. Secondly, capital gains tax. The rate will be increased from 5% to 12.5%, but an exemption will be introduced for capital gains from the restructuring of corporate entities. In regard to withholding tax, there are 2 changes worth noting. Firstly, the scope of services which are subject to withholding tax has been expanded. For example, payments for advertising services will now be subject to withholding tax. And secondly, in regard to a non-resident company with a PE in Kenya, notional service fee payments by the PE to the head office, if deductible under a double tax treaty, will now be subject to withholding tax. In regard to VAT, the withholding VAT rate will be reduced from 6% to 2%, and VAT exemptions will be introduced for Kenyan manufactured motherboards and all inputs into their manufacture, and services provided to plastic recycling plants, and the supply of machinery and equipment used in the construction of such plants. And finally, the budget indicates that the government will soon announce tax measures to deal with income generated from digitalisation. However, no details have been provided so far. Next is Tanzania, where the 2019 budget has only one item which caught my eye. There will be an exemption from withholding tax on fees charged on government loans, which are provided by non-resident banks and other international financial institutions. And the final East African budget was presented in Uganda. Here there were a few interesting things to note. Let's start with corporate income tax, where there were a number of new and amended tax incentives announced. Firstly, a 10-year income tax exemption for income derived from leasing or letting facilities in industrial parks, provided in the case of a foreigner there's a minimum investment capital of $50 million US. And secondly, a 10-year income tax exemption for operators in an industrial park or free zone, or from other business outside an industrial park or free zone, provided in the case of a foreigner there's a minimum investment capital of $10 million US. The interest withholding tax rate on government securities with a maturity period of at least 10 years will be reduced from 20% to 10%. And the government has decided to proceed in an amended form with its 2018 proposal to introduce VAT withholding. In 2018, the government was given power to designate entities as VAT withholding agents to withhold 100% of the VAT charged on a supply. However, that initiative was withdrawn shortly after it was introduced. The current proposal is to require the withholding VAT rate to be 6% of the taxable value of the supply. Importantly, this proposal won't apply to taxpayers with a good VAT compliance record. But again, there will be entities which will be designated as withholding agents. In Pakistan, the government has presented its 2019 budget. 4 items caught my eye. Firstly, the scheduled reductions in the general corporate income tax rate have been suspended. Instead of the scheduled annual reductions of 1%, the rate will be frozen at 29% for the next 2 years. Secondly, the rates for minimum tax will be increased. The general rate will be increased from 1.25% to 1.5%. And the rates for specific sectors will also be increased. Thirdly, a computational change will be made in regard to super tax on banking, insurance, and oil and mineral exploration companies. For such companies, carried forward losses and depreciation will be ignored when calculating the super tax base, which is currently the treatment for other sectors. And finally, the tax rate on dividends has been increased from 15% to 25% for dividends paid by companies which are either exempt or don't pay any tax because of tax credits or allowances. The UAE has become the latest no or low tax jurisdiction to introduce economic substance legislation, with the clear objective of being removed from the EU's blacklist. The new legislation is effective the 30th of April 2019. In the US, the Senate Foreign Relations Committee will consider 4 signed but unratified protocols in its meeting on the 25th of June. The 4 protocols are with Japan, Luxembourg, Spain, and Switzerland. These are considered easier to deal with than the 3 signed but unratified treaties with Chile, Hungary, and Poland, which apparently all require an amendment in regard to the US BEAT tax. Although not clearly stated publicly by the government, I believe that the concern is that the non-discrimination article in each of the 3 treaties might overrule the BEAT tax based on the later in time rule. The particular provision in the non-discrimination article which would be relevant is the provision corresponding to Article 24.4 of the US Model Treaty. I won't read it out. Please hit the pause button if you'd like to study this provision. Apparently, the Treasury Department considers that the 4 protocols don't require a BEAT tax amendment, even though at least one of the protocols, the one with Japan, amends the provision which corresponds with Article 24.4, but not in regard to BEAT. And it's clear that Treasury's analysis on this issue has changed in the last month. A critical letter from Senator Menendez to the Treasury sets out the history. For a copy of that letter from Senator Menendez, please go to our website or app. And we will soon receive some interesting new regulations from the US Treasury. Proposed regs in regard to the characterization of cloud computing and other computer-related transactions are at the final review stage. And now for this week's treaty developments. We've had 1 protocol signed and 1 treaty enter into force. I have 2 articles for you this week. The first article is called Offshore IP, What Next? It's written by Jim Tobin and it's published in Bloomberg BNA's Tax Management International Journal. This article considers the appropriate location from a tax planning perspective of a multinational group's IP, following the significant international tax changes in recent years and continuing. It is mainly written with a US multinational in mind. The author starts by noting this. Typical structures in the past, particularly for US multinationals, were the so-called double Irish structure, CVBV structure for the Netherlands, or simply ownership of IP in a low or no tax jurisdiction like Bermuda, Cayman, or Barbados. The double Irish or the CVBV typically also involved a non-tax entity, the Irish non-resident company, or the CV, which was transparent in the Netherlands. The typical structure achieved a quite low overall tax rate by operating manufacturing, logistics, or distribution in a reasonably low tax country such as Ireland, the Netherlands, or Switzerland, and paying a deductible royalty for use of the IP owned in the tax haven. The amount of the royalty would often be ruled upon, but under what I would consider to be the traditional transfer pricing norms would reflect both the value of the IP held by the tax haven entity as well as the risk related to the IP value. The author then notes that typical structure with the IP owned in a tax haven would be subject to significant challenges today under the DEMPI changes to the transfer pricing treatment of intangibles in the 2017 OECD transfer pricing guidelines, anti-hybrid rules in the EU's ATAD and elsewhere, diverted profits taxes in the UK and Australia, the UK ORIP rules, possible EU state aid challenges in regard to the quantum of the deduction for outbound royalties, the US GILTI rules, and the introduction of economic substance requirements in many tax havens. And so he concludes, so what does this all add up to? Get your IP out of a tax haven quickly, as any tax benefits are fleeting if still there at all. But where to go and how to achieve a transfer? And then in the remainder of the article, the author reviews various alternative locations for the ownership of the IP. The US, EU locations such as Ireland, the Netherlands and the UK, Switzerland, Singapore and Dubai in the UAE. The second article is called "The Tax Justice Network Africa and Cabinet Secretary for National Treasury and two others, a big win for tax justice activism." It's written by Daisy Ogambo and it's published in the British Tax Review, but it's freely available on the SSRN website. For a copy of the article, please go to our website or app. This article concerns the case decided earlier this year in which the Kenyan High Court held that the procedures to give the Kenya-Mauritius Double Tax Treaty the force of law in Kenya were flawed, with the result that the treaty was legally ineffective in Kenya. You'll remember that I discussed this case in ITB on the 22nd of March. The author is critical of the Tax Justice Network Africa, the successful petitioner in the case, for claiming an incorrect basis for the court's decision. The petitioner had issued a press release which included these statements. Court declares the Kenya-Mauritius DTA unconstitutional. A win for Kenyans in keeping more revenues from bilateral treaties. The author describes these statements as astonishing, astounding, and misleading. She writes, "A plain reading of the judgment reveals that it does not have the effect that the petitioner's press release claims that it has. The court did not declare the DTA unconstitutional. The court nullified the notice purporting to bring the DTA into force. Further, it did not do so on the basis of constitutional principles, but on the basis that the procedure followed in publishing the notice offended the provisions of the Statutory Instruments Act 2013. The author is also critical of the court's judgment. She writes, "This judgment has introduced undesirable complexity by holding that double tax agreements are not treaties and do not have to be ratified, a position that is untenable in light of the governing international law principles. Further, the court failed to issue a definitive, or at least an indicative judgment on how courts should approach constitutional challenges to substantive provisions of double tax treaties. Such a judgment would have been very useful in similar cases in other developing countries in the Commonwealth. Finally, the judge missed an excellent opportunity to shape the emerging jurisprudence on public participation, insofar as it applies to public finance legislation in general and negotiation of double tax treaties in particular." Well, that's the way it is this Friday, the 21st of June 2019. I'm Steve Towers. Have a great weekend.